If you've identified the primary trend in the marketplace, it's important to have patience and staying power, even through price corrections.
They've struck gold on the Titus farm here, not many miles from Cincinnati. And believe me, with gold now at $33 an ounce, boys, there's gold in that thar pan.
When you look at both the price appreciation of gold and the time that it's taken to be in a bull market, 10 years now, starting in the year 2001, gradually, 2 steps forward, 1 step back, we've seen the price of gold appreciate. This is a classic bull market. Regardless of the asset class in question, whether it's real estate, farmland, stocks, bonds, commodities, gold, silver, you can look at the development of a market and split it into 3 phases. An early phase where it's neglected and very few people see the value in owning it, except a few mavericks, a few perhaps insiders who say, it looks to be a good value. The second phase is usually where Wall Street takes a keen interest. When you look at the Dow-Gold ratio and you compare stocks and people's faith in paper assets with gold, what you have is the extremes of hope and fear in the marketplace, and they're depicted in this move. And then emphasis in gold, where people want just the metal itself. Emphasis in paper money, and the American dream becomes crystallized again in the American mind, and we say, nothing can happen to us that would derail this dream. We're in that phase now, again, just as we were in the 80s, just as we were in the 30s. Whether it's 5,000 or 50,000, we're not talking about the commodity. We're not talking about gold and its price. We're talking about the degradation of a currency. If you go back to the 1919 to 1923 period in Germany, the hyperinflation, you had an ounce of silver selling for tens of billions of marks. Everyone was a billionaire. It didn't really matter. It's been argued that you can preserve purchasing power in equities. Let's take that same period, 1919 to 1923. If you had invested in the German stock market, you would have increased your value by 13 times. A handsome reward for taking market risk. The problem is, when you factored in the currency losses, you still lost 98% of your value. Gold moved not only 13 times, but 136 times. And you walked away at the end of a currency extinction event with real money. If you want to look at this particular bull market and compare it to the last, which we did participate in as well, let's start in 1998. 1998 with the price of gold at under $300 an ounce, and it's progressed to this point, nearly 5-fold to $1,500 an ounce. While an impressive bull market, and while many of the pundits today would say it's over, it's long in the tooth, surely it's gone too far, too fast, what I'd like to suggest is that if you compare it to the last bull market, it's only just begun. Let's look at 1968 to 1980. Beginning in 1968, you begin to see the progression of gold as we launch into the 70s, as you had popular inflationary concerns, and then ultimately, as we reach the peak in 1980, priced in today's dollars, you'd have to be at $5,479 to see the same kind of percentage move today versus then. If you own gold, and you have during the first phase or during the second phase, or maybe you're even coming to it late in the game, when you buy anything, you need to know what your exit strategy is. You bought it today to sell tomorrow. We take a slightly different view to the gold market, seeing it as an insurance policy. We think that some portion of your gold holdings should be kept indefinitely.
Every bull market has a beginning and a middle and an end. It's important as it progresses to be aware of where you're at in the process. And as you get towards the final stage of any bull market, develop an exit or reduction strategy. It's vitally important, and one that must be done in a very disciplined manner with people who can competently help you with that endeavor. So when we look at the gold bull market split into these 3 phases, you have the first phase from roughly 2000 to 2005, and the price moving from roughly $250 an ounce to about $550. And in the second phase, 2005 to roughly 2010, the price moving up again from $500, $550 to nearly $1,500 an ounce. In the final phase, we think it'll transition between $1,500 and $1,700 an ounce in this final or parabolic move, and it'll take another 5 years to get there. $3,000, $4,000, even perhaps $5,000 an ounce.